It's now time to hear from another brilliant Luxembourgish mind, the former finance minister and current managing director of the European Stability Mechanism. Well, please welcome on stage the brilliant and delightful Pierre Gramegna.
So good evening, everyone. Thank you for being there. Thank you, Presh, for inviting me. Let me start not with an apology, as you normally do in Japan, and let me not start with a joke, as you normally do in the United States. And let me start by just thanking you for inviting me and thanking you for taking the initiative 2 years ago to give back to Luxembourg. A country that you love very much, a nationality that you have acquired over the years. And when I asked Presh, whom I didn't know 2 days ago, to prepare a little bit for this event, I asked him, what is the thing that has surprised you most or in Luxembourg, or the thing that you like most in Luxembourg? And he said, it's a country that's so open where I feel comfortable, and that's why I launched this event. That's what I like about this country. People are accessible, the country is open to foreigners, and I feel at home here. So thank you for launching this and having launched these conferences. Now, it's difficult for me to speak after Xavier Bettel. As you know, he handpicked me to be his finance minister. So I even hate to say he was my boss. I think we were really partners in government for 8 years. And we continue to see each other once in a while. He's traveling a lot, I'm traveling a lot too in my job as managing director of the European Stability Mechanism. Maybe I should do a poll here, but I won't do it. The ESM is headquartered in Luxembourg, not in Brussels. I meet friends who tell me, how is it in Brussels? Well, yes, I go to the Eurogroup every month, and then I spend 2 days there. I might also go on other occasions, also for the work, but I'm based in Luxembourg. No. Yes. We are behind Auchan on Kirchberg. So now we know everything. We have 250 people working there. Also there, I need to demystify this because I met someone, also good, very knowledgeable person, by the way, a banker, a Luxembourg banker. Pierre, how are you doing? Well, fine, fine. Oh, he said, do you like your new job? Yes. Well, it's much better than the one you had before. In what sense? Yeah, less stress. I said, yes, I agree. There's less bad political stress, that's true. But it's a full-time job. Yes, I mean, you have a small team, you do it. So how many people do you think I have? Well, it's 10 to 15. Okay. Then you realize that people do not know the ESM. So I'm going to say a few words on what we do, because it is important. The ESM was born after the sovereign debt crisis. Sovereign debt crisis brings us back to 2008, 9, 10. And I think it is really important to remember that at that time, a few countries in Europe had major problems to refinance their debt. And instead of paying at that time, interest rates were much higher than now, but maybe 7–8%. Some countries like Greece or Spain would have to pay 20%, 25%, and they already had accumulated a lot of debt, so they could not pay back. So, and then the reflex was, let's go and see the IMF. And the IMF would say, now wait a minute, you have a couple of European countries there that have major problems, that will cost us a lot of money. The IMF was not planned to help developed countries, rich countries. And by the way, you have your common currency. I mean, you don't have currency issues, balance of payment issues. So, I mean, you should fix that yourself. And we all realized we have put, in a certain way, the cart in front of the horse. Because we decided a monetary union and started the monetary union in 1999 on the basis of the Maastricht Treaty of 1993. But we had not thought that we need a safeguard for the euro. We have a European Central Bank, we have lots of things, but we don't have a lender of last resort, which the IMF is for the whole world. So we are basically the European IMF. But we are very original in our functioning. So it is important that I explain that, because we are the most sophisticated lender of last resort out there, also the most recent, because countries decided to have this rescue fund with a paid-in capital. So, and with a callable capital and a paid-in capital. The callable capital is 700 billion euro, and the paid-in capital is 81 billion euro. So we manage these 81 billion euros. So deciding to do that was the other element of whatever it takes. You remember the sentence of Mario Draghi when he said, we will defend the euro area and the euro whatever it takes. And the central bank took lots of decisions to make sure that that was the case. And the second thing was to say, we have a lender of last resort. 81 billion paid-in capital is the highest paid-in capital of any international financial institution, more than the IMF. Because we wanted to convince markets that we believe in our currency and we will defend it, whatever it takes. So we supported 5 countries. The most famous one to be helped, because also received 3 programs of help, was Greece, but then also Spain, Cyprus and Portugal. But the first country that received support was Ireland. Many people have forgotten that. So we have basically helped those countries with 300 billion euro of loans that we have issued for them. And that's where the mechanism is really very innovative. So with the paid-in capital of 81 billion, the ESM has a AAA rating, like a country like Germany or Luxembourg. So we can issue bonds at a very low price. And we pass these bonds over to the beneficiary countries to the same rate. So instead of paying 20% for Greece or 25%, they would pay 5%. And they are obviously reimbursing that money over time. So that's the model. So we have a firepower of 500 billion. In other words, with the 700 billion callable capital, the market considers that we can issue bonds up to 500 billion euros with a AAA rate. And so the firepower we have used up to now is roughly 80 billion. So we have 420 billion euro firepower available to solve problems for countries that are in financial instability. So the 5 countries I have mentioned, they needed to have a macroeconomic reform program. So the help is conditional, the support is conditional, but we have also tools to prevent crisis. And that brings me to what I want to share with you. Sorry, I hope I wasn't too long with the introduction, but just to see, for you to understand what I'm going to comment today, especially in my speech here, maybe afterwards in the panel that I will join, I will focus more on Luxembourg. But I want you to understand that as ESM, what we try to anticipate is what are the greatest risks for all the member countries of the euro area, which we cover. And we have identified 3. And I'm going to dwell especially on one, which is the geopolitical fragmentation, which is the topic of today. But there's also other ones that we consider mega trends, mega risks that can have an impact on financial stability of individual countries or many countries of the euro area. And the second mega trend is obviously climate change. And the third one is aging population. And climate change and aging population are long-term issues that are there to stay for 20, 30, maybe 50 years. The geopolitical fragmentation, honestly, I don't know how long it's going to last. Maybe in 5 or 10 years from now, we will have calmer waters and more peace around us, but nobody knows that. But in nature, this geopolitical fragmentation, which has started, you could say, around 2010, some say even earlier. Maybe you could say it started with September 11 in 2001. Basically, the 21st century is a century with more fragmentation, and this has accelerated a lot. Maybe I do away with the 2 topics of climate change and population aging first, and then come back on geopolitical issues. Climate change is there to stay. And you see, it is not a linear issue. And what I want to say is, it is probably useless to say, as some are doing right now, we should not walk away from the thermic engine, we should stay with that. This is for me kind of transitory rhetoric, because we need to reduce CO2 emissions. It's obvious. Look what happened in Spain last week. Look everywhere around you, we see the climate change is there, and it has enormous impact, which has then effects on financial stability. First, obviously, I would say it's the cost of these natural disasters, which basically insurance don't want to cover, or very little. Studies show that only 30% of climate change risks and then damages of storms or floodings are covered. So 2/3 of this risk cannot even be covered. So if it cannot be covered, it has a huge impact on your budget. Look, in Spain, I think they decided a special help of 10 billion euro, if I'm not mistaken. So I could go on and tell you lots of things about that. We as ESM have written a blog about this, suggesting that we should create a kind of insurance backstop. It's a kind of similar functioning as the ESM that we're proposing, that countries, maybe the 20 euro area countries or the 27, would create a fund which is a guarantee which allows you to lend money cheaply and to cover insurance risks. Lots of other things I could say on climate change, but I leave it at that, just to tell you that a country like Luxembourg, or Europe, I think for that matter, is in line with the promised reductions of emissions by 55% for 2030. I just looked up the numbers for Luxembourg. They're pretty fine on that curve to go down. I'm not sure others, all the other countries in the world are. And let me also underline one thing. China has committed to also go to net zero compared to 1990, not in 2050, but in 2060. But the fact that China has committed to it is great news. It's very positive. And I promise you, if the Chinese have said that they're going to be net zero in 2060, they will be there. Because our Asian friends are long-term thinkers. So, hopefully Europe will be there by 2050 as promised. Second issue, aging population. It is a striking feature that is becoming so predominant in all our countries. And I want you to understand that this is one of the key factors that shapes policies everywhere in the world. Germany needs 7 million people from today to 2030, or maybe 2032. 7 million additional immigrants. Olaf Scholz used that number last year. Now, if you put it that way, you scare everybody away. I would not have put it that way. But it's because the baby boomers are all retiring, and Germany is one of the countries with the lowest birth rate. Now, this is true for Italy too, also very low birth rate. How do you fix that? Well, there's two possibilities, or three, but certainly, if you don't want immigrants, you will have to settle for a lower GDP, lower social safety net. Now, if that's the choice of a country, it can be an option, but I'm afraid very few people would like to choose that route. The other one is to say we must have immigration and we must make sure these people integrate well, and there's no other choice. The other thing with this trend and aging population that we have also identified, which is less perceived, is with aging population you have less innovation. Less innovation means your economy grows less, and this is a side factor of the problems that Europe is meeting. Last but not least, on this trend, which is a general one in the world, in particular in Europe, I would say Luxembourg is a happy exception. A happy exception for the time being, because we have 47%, as you know, 40% foreigners living here. The average in the EU is below 10%. And the EU is a place where there are quite a few foreigners. In Japan, there's 1% foreigners. So we are an exception in many ways. And because we are such an open country, obviously we have less of an aging population issue than others because we add new people every year, new jobs, younger people. So we are one of the only countries, as a finance minister I know the numbers well, that has a huge surplus in our pension funds. And we are accumulating every year additional profits. But the day we do not create new jobs anymore, we will have the same problems as others. A last thing, because today I had the opportunity to have the rector of the Luxembourg University at the SM headquarters. We had a very interesting seminar on AI, artificial intelligence, and the rector made a brilliant presentation, and he said, my favorite day at the university is the first day of university in September when we open, and he showed a picture of that, and then he says, what I communicate as the first message to the students, to the newcomers is, be sure that 60% of you here are going to stay in Luxembourg and find a job here. You have to keep in mind that Luxembourg University is the most international university in Europe, if not in the world, because I think it has 60 or 70% foreign students. So this is one thing that epitomizes the openness of our country, and this openness is what helps us solve our problems to a large extent. Last but not least, then, the geopolitical fragmentation, the wars all around us. This being said, we in Luxembourg and in Europe, we talk about two wars. The Ukrainian war and the war in the Middle East. Do you know how many wars are going on in the world that are registered wars? 47. That also tells you something, that when we speak with Indonesians, I take by chance Indonesia, I could mention Uganda, I could mention Argentina, and tell these countries it's terrible what happens in Ukraine. It's terrible what happens in the Middle East. Well, the Argentinians will say, well, wait a minute, there's a war there in South America nobody talks about. We are very worried about that war. So we sometimes lack perspective here. My point is, there's more and more wars going on, leads to fragmentation. Fragmentation, political, geopolitical fragmentation on the one hand, which brings about less exchanges of goods, of services, eventually even less people moving back and forth. So it means that we are deglobalizing world trade. It is, in a way, regionalizing. I will talk at the end of my intervention on the European Union. But we are in a deglobalization, or at least it's a new word, slowbalisation of world trade. And who is the greatest victim of slowbalisation or reduction of world trade? The EU. The IMF has calculated that if the trend that we have now continues, and in terms of war and geopolitical fragmentation, we will lose 7% of GDP in the coming years at world level. For Europe, exports and imports together represent 60% of our global GDP. 60. For China, exports and imports, and we know what a powerhouse in terms of exports China is, as we are too, as Europeans, but exports and imports of China represent only 34% of their GDP. And for the United States, the number is 24%. So if world trade goes down, we are hit much more than others. The other thing which is key and has been highlighted a lot and will stay with us for quite some time in the context of the war in Ukraine, that is that our dependency on energy. And the cost of our energy, which is a multiple of the costs of energy in the United States. When I say multiple, it can be double, triple. Ask an industrialist, someone who needs a lot of power. This kills your business model. Point number one. Point number two, the United States is a net exporter of oil. That means they are so they have enough supply for themselves. They even have overflowing energy that they export. And we need to import between 50 and 60% of our energy. So you see this gap is really not peanuts. And you cannot solve this issue in the short term. The only solution is renewable energy, renewable energy, renewable energy. Costly in the beginning, but afterwards very efficient, but it takes time. You will not be able to build this in a short period. Third thing I would like to highlight is that in a world of deglobalisation, for Luxembourg, which is a small country, landlocked, this is very bad news. But I think Luxembourg is one of the countries that can cope with it, in the sense that, for example, our financial center is still developing very nicely, diversifying, and innovating a lot. I remember, because that's when I was in charge, we were the first country, together with France, to have a framework, a legal framework for blockchain technology, so that you could make blockchain contracts that have legal value that is recognized. We were pioneers like that. And Luxembourg has done this over and over again. We are attracting a lot of talent. So for the financial center, I think there's a lot of promising avenues that we can develop. But that being said, we are small, and there's one area where we're extra small, that's defense. And defense is obviously the other elephant in the room. I think I have to stay with this image. One is this energy costs, or let's say first the trade issue I mentioned, energy costs, but then defense. Defense, because we're lagging behind since decades. The United States in NATO have asked European countries to do at least 2% of GDP of spending on defense, but they haven't done it. Some of them have done it. Luxembourg is around 1%. Many are behind, but even 2% might not be enough. And then, obviously, with the result of the elections and what the attitude of the United States is going to be in terms of fostering NATO, keeping it as it is, or wind it down, question mark. So we will have to spend even more. I'm confident on the fact that we really remain strong allies of the United States and vice versa, but how much we can have a common defense with the United States needs to be seen. And last but not least, we don't even have the beginning of a European common defense. So these are costs that are enormous. So conclusion of all this is a bit pessimistic what I'm telling you, but I think it's obvious that that's the consequences of geopolitical situation we're living in, is the only answer I see for all of us is Europe. We need more Europe, not less Europe. And both the Letta report on the single market, which was issued in April, and the Draghi report, which was issued in September of this year, dedicated to competitiveness of Europe, highlight, in fact, two things. Let's maybe stay with the competitiveness issue, where we're lagging behind a lot. Now, if you would have asked me in 2020, when COVID started, and if, with hindsight now, we know that 2022 we have the war in Ukraine, and you would have asked me, we would be where we stand today in terms of GDP and growth and unemployment and so, I would have said, you're an optimistic person, that's not possible. So we have done well in a situation of extreme crisis. Don't misunderstand me. I'm not saying that we have done badly. In fact, we have developed solidarities that I did not expect would be possible at European level. Nevertheless, we have had a soft landing of the economy after COVID and after the energy crisis and inflation, but let's face it, we have a shallow growth below 1% since 2 years or maybe 3 years, and there's a risk that this slow growth becomes structural. So that's why the Draghi report says we need more competitiveness, we need more investment. He doesn't give us the answer how to find that investment. I leave that for you to think of for the panel eventually. And then on the Letta report, he speaks about the single market in a very interesting way. I recommend you to read The letter report reads very well. It's also a nice language. And he has also published it as a book, so it's very nice to read. And he has said, yes, the single market is the greatest success story of European history, I would say, together with the euro, because it's the free movement of people, goods, services, and capital. And it is functioning. It needs an update and a modernization, but it's the best thing we could do, and we have to work on that. And he even adds a fifth liberty, which he calls an intangible liberty. You probably needed an Italian to invent an intangible liberty, so that means that you cannot touch it. And I would like to just finish with that. And there's two things he says there are many more, but that I want to pick. One is that he says education is key. So we should do Erasmus programs and other things in education, but Erasmus programs compulsory all over Europe, because it's such a success. We are using it, we're doing it now, but in a very limited amount. And the second thing he says, we talk about liberty of coming and going, Schengen, passport for Europe, and all the opportunities that this offers. But we have completely underestimated that many people just like it in the place where they are. Be it in the countryside, be it in their country, in the northern part of Poland, or in a Baltic state, in the heart of Luxembourg, in Sicily, or somewhere in the middle of Spain we never heard the name of. If the message is, we are really good at offering you the possibility from the heart of Spain to go to the Baltics, or vice versa, well, 9 people out of 10 say, I couldn't care less, I'm not interested. So we should also care for people to be able to stay where they are and be happy where they are and have possibilities to have an economic activity or find a job. So it doesn't mean that everyone needs to stay in the field. In Bourg-Morange, for those who know Mauskety, the Luxembourgers, there are not that many in the room, but those who are Luxembourgers understand what I mean, meaning it's not that everyone has a right to just stay all his life in the same spot without moving, but just to say the message is we must also care for those who want to stay in the country, in the region where they were born or feel comfortable. I thought it's really interesting to have that angle, so I leave that with you. I've been far too long, but I hope you enjoyed, and I look forward to the panel. Thank you very much.